So in today's video, I'm going to show you the easiest and most consistent way that you can learn and look at market structure. And this is the way that I've done this for years and years now, especially since I made the transition to supply and demand and smart money concepts. This is the way that I've looked at market structure now for many years. So I know this is proven and I know this works 100%. And if you go ahead and nail this and really get to grips with this way of marking market structure, you will significantly increase your strike rate and significantly decrease the amount of times that you are on the wrong side of the market. So first of all, what I want to do is just sort of explain market structure, and especially for the people that are sort of new or beginners in the trading space, and just tell you a bit of the rules that we need to look at when we're looking at marking market structure in this way. Now, as you can see, we are in a bearish market right here, and a bearish market just means that we are trending down. And a couple of the rules that we will need to go by is the highest and lowest point before the break. So in this case right here, the highest point before the break to the downside will be our swing high, which is marked by this green dot right here. Now, this high is not confirmed until we break this low to the left. And why? Because the simple reason is if we don't break this low right here to confirm this swing high, what can happen is, this price leg right here might just trend to the upside and break the previous swing high, and then sort of taking us into a bullish market instead of a bearish market. Now, as you can see, what we're doing is we're making lower lows, lower highs, lower lows, lower highs, and this is predominantly what will happen when we are in a bearish market. And also, the second rule that we will need to go by is we will only see and confirm a break of structure once we break this swing low right here with a body close and a body break. So with that being said, this is a bearish market, and if we move on to the next slide right here, as you can see, what will happen when we are in a bearish market is we are trending down, we make lower low, lower high, lower low, lower high, lower low, and then what you will notice that happens is we come up and we break this most recent swing high right here. Now, a lot of smart money traders and a lot of people that trade smart money will think this is the market going bullish. And this is the reason that I've added in, a crucial rule to keep us on the right side of the market, because, normal supply and demand traders, normal smart money traders would then be looking for buys sort of from around demand zones around here, maybe some sort of area of interest, fair value gap, whatever you want. And then what you will notice when we are in a bearish market and we come up and take the most recent swing high right here, a lot of the time we will just continue down after we've taken liquidity above this high. Now, to get around this, what we would do is on the next slide is we will go ahead and look at market structure in this way. So we come down, lower low, lower high, lower low. We then break to the upside, giving us our higher high. And this is only confirmed once we get a break of this high right here. So what we need is 2 times boss in the opposite direction to confirm a trend change. So as you can see, lower low, lower high, lower low, a new higher high, a higher low, and then to confirm the trend change, we need to break this high right here, giving us 2 breaks of structure in the opposite direction. Now, the first break right here is the first sign that we are going to get a trend change, so this is why I've marked this as chalk. And then the second boss is the confirmation that we are then going bullish, and this is the a more conservative way and a better way that you can higher your strike rate and more often than not stay on the right side of the market. So with that being said, these are all the rules, and this is the way that we will be looking at market structure. So what I'll do now is I'll go onto the charts and sort of mark it out in real time, showing you what it would look like in a real life scenario with a candlestick chart. So as you can see now, I am on my charts, and what I'll do is I'll just start off at a sort of random bit of price action right here. So what we'll do is we will start around here, right? So first of all, we have got our first break of structure right here. So we've got a break of structure to the downside. And what you can do as well with the green dots is you can go ahead, come over here, get this little tool, and then you can mark out your green dots showing us our swing high. This right here would be our swing low. And then once you get a break with a body close to the downside, you are then looking for your pullback in order to see where our break of structure would be next. And then as you can see, what we do is we get a pullback right here, and then we get a break of structure to the downside. So what these green dots do is kind of keep it, quite clean and show us where our swing lows are and our swing highs without, getting mixed up in all of the noise on the time frame that we are looking at market structure on. Again, as you can see, we break structure to the downside, and then we get a significant pullback right here, and then another break to the downside. Now, this bit of price action right here is really, interesting, because what we do is we do take liquidity above this high. First of all, I will mark out my swing low. I will mark out my swing high. This right here would now be our new swing low. And then what we get is we get a sweep of liquidity with a wick above this swing high. Now some people might see this as a break of structure to the upside. For us, this doesn't signify a break of structure. All this signifies is a sweep of liquidity. And then once we get a break of this high right here, our bias remains the same and it still remains bearish and to the downside. And then as you can see, what happens is price comes up and then it trades to the downside and breaks our most recent swing low. So our swing low is right here, it's broken with this candle and then it trades down. We get a significant pullback right here. So this right here would be our swing high. This right down here would be our swing low. We get a pullback and then another break. So this would be a break of structure to the downside. This kind of keeps it really clean when you're looking at structure in this way. And what I want to note down here is we do get sort of a consolidation and a little bit of a pullback. Now some people might not see this as a pullback because it might not be, you know, a significant enough pullback for a lot of people, but in our case this doesn't really make much difference with our rules because what we get is one break of structure to the upside. So this doesn't actually confirm that bias has changed to bullish in our case. So if you want to mark this as a break of structure, that's absolutely fine and it won't really affect your results in any way, shape or form because we get a break of structure there and then we get a break of structure to the upside. And then as you can see, we don't actually get our second break of structure to the upside, so our bias remains the same and our bias remains bearish. So as you can see, we get a break to the upside right here. Price then reverses and comes down and breaks structure and continues with our bearish trend. Now as you will notice, we come down, we get a break of structure to the downside, we get a pullback and then we get a further break right here. Another break to the downside. Again, we get a break right here. So if we zoom in and just kind of look at this in sort of a magnified, perspective, we break down here, but this is only with a wick, and the break of structure is confirmed once we get this candle close below our recent swing low, which is this one. And then what happens now, which is very interesting, is that we come back up, we break our most recent swing high. At this point, this would be our first change of character, signifying that we could be changing trend. So what we do now is we wait for a second break of structure, or we wait for this structure low to be broken down here to confirm that we're still bearish, or to confirm that we're going to go bullish if we get a second break of structure to the upside. So let's see what happens on this bit of price action, right? Let's just play price forward. So we get a pullback now, and then we get a break of structure to the upside. So this would be our swing high. So what we've got, right, if I just go ahead and get this right here, we've got our swing low, we've got our swing high, we get a swing low put in right here, and then we break this, confirming this swing low. Once we get a break of this swing high right here, we've got a break of structure 1, push up, pull back, break of structure 2, and now we are signified as bullish. So let's see what happens to price if we just play price along. So we get a pullback and then we get a further break to the upside. So we get a break right here, and then as you can see now, the market has totally changed direction. We have changed in trend and now we are trending bullish. So if we zoom out now and kind of look at our structure, we've got structure coming down like this, right? We've got lower lows, lower highs, lower lows, lower highs, lower lows. We come up, we take liquidity, continue down, lower low, lower high, lower low, lower high, lower low. We come up, take liquidity, continue down, lower low, lower high, lower low, lower high. Our first changing character signifying to us that we could be changing trend, but we wait for facts and we wait to see what is actually happening. We get a pullback, a second break, and this is when our market structure is now confirmed bullish. And then as you can see, price just continues to the upside, and this is how we can stay on the right side of the market more often than not. So this is kind of how market structure works, and these are a couple of rules that you can add into your trade plan. And what we are doing is we are waiting for hard, solid facts on where the market is more likely to go. And obviously if you look at price over the last 2, 3, 4, 5 years, you will notice that we can come down. Again, if I just reiterate this, we can come down, lower low, lower high, lower low. We can come up, take liquidity above this high, and then continue bearish. And this happens a lot over, you know, a large sample size. And then what we can do is we can wait for facts and then wait for this second break right here, and then once you get that, that is when we are confirmed bullish, and then you can start looking for long trades. So this is one way that you can look at market structure, which is very, very consistent. Like I said before, I have used this way of marking market structure over the years, so it is confirmed to work. It's an absolutely brilliant way at looking at market structure, and I urge you to go ahead, backtest this, look at this on the market. It works pretty much on any time frame, any asset class, so you can go through, look at this yourself. If this makes a difference to your trading, go ahead, leave a comment down below and let me know. If this video did help you out, please leave a like on today's video, and as always guys, thank you very much for watching, and I will see you in the next one.